There is a 3-digit number that decides wherever you can rent an apartment, buy a car or get a mortgage. This number was invented by a private corporation. Welcome to Tough Finance. Today we go deep on credit score, what it actually measures, who built it, who profits from it, and how to make it work for you in a system you never agreed to but cannot opt out of. The modern credit scores as we know it was developed by a company called Fair Isaac Corporation, now known as FICO, founded in 1956. The FICO score is a standardized customer product launched in 1989. Think about that timeline. For most of American financial history, 50s, 60s, 70s, lending decisions were made by local bankers who knew their customers personally. The system had enormous problems. It was riddled with racial discrimination, gender bias, and old boys network favoritism that systematically excluded entire population from credit access. The FICO positioned their credit score as a solution to that discrimination, objective, data-driven, colorblind, a number that removed human bias from lending decisions. And in some ways it worked. Credit access expanded dramatically in the 19th and 2000s. People who have been denied loans by biased local bankers got mortgages and car loans and credit cards based on their actual payment history rather than their race or gender or who their father knew. But here's what happened alongside that democratization of credit. The scoring system itself became a product, a very profitable one. FICO earns revenue every time a lender pulls your score. The three major credit bureaus, Equifax, Experian, and TransUnion, earns revenue collecting and selling your financial data. A massive industry of credit monitoring services, credit repair companies, and score optimization tools that have been built entirely on the foundation of a number you didn't ask for and cannot ignore. The credit score solved a real problem, and then a lot of people figure out how to make a lot of money from that solution. Here's what the FICO score actually calculates, and more importantly, what it doesn't. Your score is built from 5 components. Payment history, 35% of your score. Do you pay your bills on time? This is the most important factor and most rational one. A pattern on the time payments is a reasonable predictor of future on-time payments. Credit utilization, 30% of your score. How much of your available credit are you using? The scoring model rewards using less than 30% of your available credit limit, ideally below 10% for the highest scores. Length of a credit history, 15%. How long your accounts have been open. Older accounts help your score, which means the 22-year-old with no credit history is penalized not because they're bad credit risk, but because they're new to the system. Credit mix, 10%. Having different types of credit, cards, installment loans, mortgages, scores better than having only one type. The system rewards complexity of debt products regardless of whether that complexity serves the borrower. New credit inquiries, 10%. Applying for the new credit temporarily lowers your score. Even checking rates for a mortgage, a financial responsible action, can ding your score. Do you notice what this system does not measure? Your income, savings, your net worth, your investment accounts, and your actual financial stability. A person with 2 million in index funds and no debt could theoretically have a mediocre credit score because they don't use credit products. A person with 200 in savings and 15,000 in credit debt but makes minimum payment on time could have an excellent score. The credit score does not measure whether you're financially healthy. It measures whether you're a reliable participant in a debt system. Those are not the same thing. Here's where the credit score story moves from interesting to genuinely uncomfortable. The original purpose of the credit score was to help lenders make lending decisions. That use case is rational and defensible even if the system is imperfect. But the credit score has expanded far beyond lending into areas where its relevance is questionable and its impact is significant. Landlords run credit credit checks, and bad score from medical debt you dispute, a bill from a hospital visit 3 years ago that you never agreed to and are fighting can get your rental application rejected. You cannot rent an apartment because of a healthcare system failure that damage your credit score. Employers in many states can run credit checks on job applicants. There is a limited evidence that credit score predict job performance. There is a strong evidence that credit scores correlate with race and socioeconomic background. Screening applicants by credit score for non-financial roles is arguably discriminatory in practice and even when it's legal in principle. Insurance companies in most states use credit-based insurance scores to set premiums. People with lower credit scores pay more for car insurance and homeowners insurance, not because they file more claims, the correlation is weak, but because the actuarial models say they might. You are paying a financial penalty today for a financial difficulty you experienced in the past. The credit score started as a lending tool. It has become a general purpose financial reputation system applied in context it was never designed for and that it measures poorly. Enough analysis, let's talk about what actually do with information, because you cannot opt of a system and high score genuinely saves you money. The mortgage interest rate difference between 620 credit score and 760 credit score on 300,000 mortgage is approximately 1.5% in typical rate environment. Over 30 years that difference costs approximately 100k in additional interest payments. The system is imperfect. The cost of a bad score is very real. Optimize it. Pay on time every time automatically. Set up autopay for at minimum the minimum payment on every account. One missed payment drops your score by 60 to 110 points. Autopay costs nothing and protects everything. Keep utilizing below 10%. If your credit card limit is 10k, keep your balance below 1000 when your statement closes. Pay it in full every month. Use the card for regular purchases to build history. Pay the full balance before interest charges. The card works for you. You do not work for the card. Do not close old accounts. Length of credit history matters. Closing your oldest card because you don't use it anymore shortens your average account age and hurts your score. Keep it open. Put a small recurring charge on it. Pay it automatically. Forget it exists. Dispute errors aggressively. Approximately 1 in 4 credit reports contain errors significant enough to affect lending decisions according to FTC research. Check your report annually at the annualcreditreport.com, the only federal mandated free report site. Dispute anything inaccurate in writing with documentation. Add yourself as an authorized user on a long-standing account. If a family member has 15-year-old credit card with perfect payment history, being added as an authorized user adds that history in your file. You don't need to use the card, the history transfers. And here's the uncomfortable philosophical end point of everything we discussed today. The credit score system was built to solve a real problem: discriminatory and inconsistent lending decisions. It partially succeeded. Credit access expanded, bias became less overtly personal, but the solution created its own problems. It built a surveillance infrastructure around consumer financial behavior that has been monetized far beyond its original purpose. It created a system where financial mistakes follow people for 7 years, not because that serves any rational lending purpose, but because that's how the law was written by people whose industry profits from long credit memories. It created a country where a medical emergency, something that happens to you not because of you, can damage your financial reputation for years, where a divorce, job loss, single catastrophic event can take a half of a decade to recover from on paper, even after you rebuild in reality. The credit score is a tool. Like most financial tools, it is more useful when you understand its design than when you accept it as a natural law. It was built by people for purposes, with incentives behind those purposes. Understanding that doesn't let you opt out, but it might make you angry enough to pay attention to it and smart enough to master it. This is the Tough Finance. We play the game, we just never forget who designed it. Subscribe, because the next video is going to make your credit bureaus even more uncomfortable than this one did. And if you have never never pulled your free credit report, do it tonight. You might find something that's been costing you money for years without you knowing it.